Hello, my name is Carlos McGorder, CPA, and I am here with another analysis. Today, we're going to go over Airbnb. I saw that this stock was trending, and I was wondering if it has reached value territory. I know the stock has been down since the IPO, so I wanted to take a look at it. And we're going to do a deep dive into the fundamentals and then give a little insight to the intrinsic valuation of this stock. So let's take a look. Now, first off, looking at Airbnb all time. They IPO'd few years ago, and was, as we see, this is why you do not touch IPOs. Almost always, you're going to have a downtrend for some years before the stock is, I would say, investable. So of course we have this downtrend because at the height of, was it 2020 or 2021? They IPO'd in 2020, and a lot of people were excited about it because of course during that time after the pandemic, there was so much IPO activity going on. Everybody was excited and optimistic. So this is one of those stocks that IPO'd and benefited from that. It spiked over $200. Now it's down to $114. This is why we stay away from IPOs. We like to let companies IPO and then prove to us that they're a good company with consistent revenue growth and consistent earnings. So we keep that in mind as we move forward. IPO'd and the stock is down ever since then. Had a slight uptrend here. Maybe people thought that was going to be a rebound in beginning of the year. Now it's back down 21% all time. So nobody, unless you're trading in these intervals, nobody is making money off of Airbnb. So keep that in mind as we move forward. Now let's take a look at the fundamentals of the stock. So looking at the revenue growth, over the past 5 years, they've grown at 27.5%. That is typically a high growth state. So we like to see that, especially for companies that are newly public. They're still growing high. 10 years, they don't have 10 years of financials yet, but that's about 26% since they've gone public. Now, I want you to notice this. Right now, they're at 5.9% for the last 12 months. So half of 24 and half of 23. So it seems like their growth is declining. However, Airbnb is a cyclical business. A lot of people are going to travel in the third quarter. So July, August, September. So I would expect this to be back up possibly around that 18%. We'll take a look at that later and kind of give our estimate of the future growth rate. So looking at that looks pretty solid as far as the revenue growth, pretty consistent. Margins for a newly public company, this is great. Also a software company, some people think of them as a hospitality company, and I believe that's their technical classification. But if you think about it, they're a software company. They don't have the capital expenditures that a typical hotel or travel company would have, or a company in the hospitality industry, I should say. So very solid margins, I would say, remnant of a software company, as I believe they are. So margins and revenues both look pretty solid. Averaging at 79% for the past 5 years. That's great. Looks awesome. So looking at the free cash flow. Free cash flow, we are started at $151 million all the way up to $4.3 billion. Solid growth. 1 year of negative free cash flow in 2020, which makes sense because that was a pandemic year. A lot of people just were not traveling. So that totally makes sense. But of course, they rebounded pretty solid there, growing up to 424, 57, 12, and 14% growth of the free cash flow. Also, I like to look at the free cash flow conversion. I want to know how much of your profit is actually coming in through cash. So we see 179, 80, 90%. We do want to see that above 90 typically. But again, newly public company, they're doing some things to bring in some money. We're going to look at their debt and their equity as far as how many shares that they're selling, looking at trend. But this makes sense as far as a company, or I say this looks good for a company at this stage in their development, that they're actually converting that much cash into, or that much profit into free cash flow. So we like to see that as well. So looking at the balance sheet, looking at debt to free cash flow. How fast can the company pay off their debt? We want a company to be 3 years or below. We'll accept 5 years if their free cash flow is strong and growing, but typically 3 and below is the sweet spot. So we see 381 million in debt in 2019, all the way up to 2.2 billion. But we know that cash flow has been growing as well. So I would say questionable, 3.9. We don't like to see that, especially for a company that was just kind of starting out being public. -3, 4 because they had that bad year of 2020. So that's understandable. But outside of that, they've been pretty solid, averaging 1.1 years to pay off all of their debt. So they keep their balance sheet and a properly leveraged position. So we like that. That's a good sign. So going over to shares outstanding, they don't have any dividends, so we're skipping that. We like to see a downtrend in shares outstanding typically. Now, for a company that is this new, this makes sense. They're bringing in shares what I believe, at a premium. So it makes sense to sell shares when their shares are more expensive. So they're selling shares at a premium and bringing in cash at a much cheaper rate, or pretty much for free, versus taking out more loans where they'll have interest rate and the obligations to pay back that debt. So a new company like this trend makes sense. We don't like that, but we can accept it for new businesses and for businesses that are overvalued during this time. So the company is bringing in capital efficiently. So I believe that is what's going on. So again, we don't like the uptrend, but it makes sense. It is understandable for this business. So let's look at the economic value added. We want a company that creates value by keeping the doors open. We want a company that has a return on their capital that is higher than their cost of capital. So we want to look at that right now for Airbnb. The 3-year average return on capital employed is 16.47%. Compare that to the weighted average cost of capital of 8%. They have a value creation of about 8.35%. That's pretty good. Pretty solid. However, if you were to compare Airbnb, which is a software company, an IT company, to the rest of the software industry, they're kind of lagging behind there. The software industry is at 19.9%. With a slightly higher weighted average cost of capital, but their value creation is at 10%. So we are at about a -2% spread when it comes to creating value. So we want a company to create value, as Airbnb is doing, but we also want them to create it at a higher rate than their competitors, and they're just not there yet. So this is positive, but not the greatest, since they have this -2% spread behind the average competitor. Or the average software company, I should say. So now that we looked at that, let's talk about what we think the growth rate is going to be. Now, what I like to do, of course, is go to the financial statements, go straight to the 10K and learn about the business. Go to the 10K and scan it, and you're going to know more than 90% or 95% of the people who claim to know about businesses. So check this out. We have right here in the risk related to our business section, Airbnb is telling us this. They're saying our revenue growth rate has slowed over time, and we expect it to continue to slow in the future. So keep that in mind as we're looking at the potential growth rate. It's been growing at about 27, 28% since 2017, since they've started, which is, again, solid growth, but not in the future. They're saying that it's starting to slow down, and we expect it to slow in the future as they become more established, and as their territories as begin to saturate their opportunities, they see the revenue coming down, amongst some other issues. So we want to look at that. So what do we expect it to grow at? So let's look at another factor, the key business metrics. Every business, depending on their industry, what their focus is going to have particular metrics that are unique to other businesses, unique to their business. So right now, Airbnb, we have the nights and experiences booked. They had 394 million nights booked in 22, and 23, 448 million nights booked. So a 14% growth rate there. Now, with that 14% growth rate, we have the growing booking value that grew 16%. Now, why did it do that? Of course, we have the increase in nights booked, but reading the financial statements, they have a small, about 2% increase in the average daily rate. That's why their pretty much revenues went up about 16% compared to the 14% in actual nights booked. So they're growing at about 16% rate right now over this past year. Now, one thing that you have to keep in mind, Airbnb has had some troubles, I would say legal troubles. So pretty much, I don't know if you recall, but New York City came out with a regulation, a law that said you are not able to rent out your apartment or your residence for less than 30 days unless you, the owner, remain on the property during the stay. So this is a pretty much direct attack on Airbnb. Now, this makes sense because if you think about it, we know that there's a housing shortage. We know that there's not enough properties or not enough supply to support the demand of people wanting to buy, which drives the cost of real estate very high. And of course, New York City, they're thinking about, okay, we want residents to be able to afford to live here. And we want the residents to afford to live here because these are the ones that are going to go to the grocery stores and go to the restaurants consistently and their children will go to our schools. However, with all of these investors coming in and buying properties and renting out to Airbnb, you hurt the residents, you kill the housing market because you have so much supply for little demand. So this is a direct attack for them to say, hey, we want y'all to, follow these rules, pretty much getting rid of Airbnb in Manhattan. So check this out. Airbnb today has went and filed for this ruling to be reversed. But I want you to see something right here. The number of Airbnb listings allowing stays under 30 nights has fallen 83%. So their nights booked has decreased in Manhattan by 83% because of this regulation. Now, one thing you have to understand, Airbnb might be able to get this reversed because if you will go to read the rest of the article, there wasn't much impact to the vacancy rates of the apartments, and also the hotel costs have increased. So Airbnb has said, hey, with us being available in this area, we make tourism more affordable. So please let us back pretty much into your market. But we'll see what happens with this. And you have to understand something. Other cities can, especially if this is not overturned, other cities can see this as a potential way to buffer their real estate market, keep Airbnb out and allow residents to buy up the demand in their cities and their metro areas. And we can see this in other cities like Chicago or Austin or Dallas or LA. You never know how far this can go once New York did it. So that is something that I believe is a big risk to Airbnb because this isn't settled. So we have to remember that as we're thinking about how far can this company grow or how fast is it going to grow in the future. They could have some major troubles with this in the future. So we got to keep that in mind. Now let's go to what analysts are saying. Analysts are saying that this company is going to grow at 18.6% per year. Compare that to how they have been growing at about 27%. So this estimate is in line with them saying, hey, our growth in the future is going to continue to slow. So that could be a solid estimate. Now, of course, you want to be conservative. What if they are unsuccessful with overturning the New York City ruling? And what if a few other major cities begin to put those laws in place as well? What happens? What happens to their revenue? We want to be safe and we want to make sure if we're projecting the growth, we're keeping that in mind and not being too optimistic when it comes to a business. We always want to be conservative. So when we do that, let's look at the free cash flows. I believe, or the intrinsic value. I believe a safe number to estimate is 10% growth for the next 5 years. Now, with that said, the value of Airbnb is $71.80 if they're going to grow at 10%. Now, of course, I have other assumptions involved in this analysis, but I'm just kind of giving you my opinion and the kind of high level view of the intrinsic value as I see it. 10%. Now, imagine that I'm wrong and the analysts are right, and it actually grows at 18.6%, right? If it grows at 18.6, that means there's worth about $89, almost $90. Still a downside of 23%. Now, for Airbnb to be valued, fairly valued at $117, how much does the business have to grow? Remember, when we're buying the stock, we're buying the future cash flows. How much does the cash flows have to grow for $117 to be kind of spot on fairly valued stock? Let's take a look. If the company is growing at about 29% per year, that's when you can expect this $117 purchase price to make sense. Unless you're dollar cost averaging and you're buying no matter what, periodically. You want to be careful at that 117. They're growing at about 27, 28% per year, and they're already telling you, hey, our growth is slowing and is going to continue to slow. So they're saying we're not going to grow at that 29%. Fair value for this company, I believe, is within the range of $88 all the way down to $71. So $71 to $88 is kind of the fair value range for Airbnb based on my opinion, based on my assumptions. So outside of that, I don't see it as a very quality stock because I don't see it as a very safe stock because of the future legal proceedings that they could have at any jurisdiction at any time. And we don't know what the result of this challenge to the New York ruling is going to be. So this is not necessarily a safe investment right now. So looking at a summary of Airbnb, we like the revenue and margin trends. We also like the free cash flow trends. The balance sheet, they stay in a pretty solid leverage position, averaging about 1.1 years to pay off their debt. We like that. They don't have a dividend policy right now, which makes sense as they are, pretty new company without a very long time of consistent cash flows. So that makes sense. Shares outstanding is trending in the wrong direction, although we can kind of accept it for a company this new. Value creation, they are creating value. They do have a return on capital higher than their weighted average cost of capital, but they are trending behind like software companies. So positive, but not in the best position because they're below the average there. And not properly valued. Definitely an overvalued stock in my opinion. So now, what did we do? We looked at the fundamentals. We saw how fast the company was growing in the past. We looked at the financials to see what insight are they giving us to their future. We see that they're telling us that they're not going to grow at the same rate. We included that in our analysis. We came up with a 10% growth rate to say, hey, we want to be safe. Analysts are saying 18. We don't know what other legal troubles they might have in the future. Let's reduce that to 10%. We think that's reasonable. We think that's safe. And based on that, we see that this stock is grossly overvalued. So not really a safe zone as far as price is concerned. And in my opinion, not a very quality investment because of so much uncertainty in the future. So that wraps up this analysis of Airbnb. So I hope you enjoyed that. Let me know what you think about this in the comments, and I hope to see you in the next video.